But you can see from Tesla, we kept buying it every time, the conventional wisdom took it down. And it has gone from $25 to $30 to $1,000 in
You made your well-known prediction about the Tesla stock price. Did you imagine the response that would occur and the motivation to invest in ARK funds?
We got a lot of pushback by the traditional financial world, both the buy side and the sell side of the street. Where we found great success was with young people. They knew they loved this car. They went out and tried this car out. They knew that they wanted to be invested. Tesla wasn't in any index. Most traditional firms now are very index driven. And so people who were looking for portfolios with Tesla in them did not have many places to go. And we have a social strategy. And so we were educating, pushing our research out about Tesla, about electric and autonomous. And it captivated the attention of a lot of young people.
Do you think the incumbent car manufacturers have a chance to catch up in any meaningful way?
I think they waited way too long to turn their R&D spending into electric. And we know because of Tesla's barriers to entry right now, the battery technology is different from any other electric vehicle, except for a couple in China. It's cylindrical lithium-ion batteries as opposed to pouch. And we know that Tesla's costs are going to be lower for at least the next 3 years than traditional auto manufacturers. We also know that Tesla, and this is taking a leaf from Apple's book, and this is when people ask me this question about automobiles, I reflect on what happened to the handset industry, Nokia, Motorola, and Ericsson. When Apple came along with the iPhone 7, they had not defined the market correctly. They were thinking about the latest fashion fad to create their next phones. Whereas Apple created a chip because it knew this was going to become a computer and that we'd be able to access the internet and voila. And it ran away with the lion's share of the profits of the market, even today. Tesla's doing the same thing with autonomous technology. It designed its own chip. No other auto manufacturer has done that. And it has been collecting miles of data for years now. It now has effectively almost 2 million robots, including my Model 3, out there collecting data. So it has more real-world driving data than any other company. It's going to be very difficult to catch Tesla in the United States when it comes to autonomous. When it comes to electric alone, well, maybe their brands will mean some success. I know the F-150 Ford Lightning has had to double its production because of the orders. We're very happy to see that. We want, and there will be a consolidator, sort of like Walmart in the retail space. Walmart and Costco and Target have consolidated it more and more as Amazon has come through. We think there will be a consolidator in the auto industry, but we think it will look very different from what it looks like today. Interestingly, I think a lot of people are trying to figure out what's going on already, because auto sales in the US peaked at a seasonally adjusted annual rate of 18.25 million units in last April. They've dropped from 18.25 to 12.4 in December. And I think what is beginning to happen is consumer preferences have shifted, so the next car they want is an electric vehicle, and they're willing to wait for it. When it comes to Tesla, for example, it's been critical to our understanding. Auto analysts should not be following Tesla. Should be robotics analysts, energy storage, artificial intelligence, software as a service. And we have 3 analysts following Tesla. There's big misunderstanding of innovation and innovation stocks. We're going through it again now. But you can see from Tesla, we kept buying it every time, the conventional wisdom took it down. And it has gone from $25 to $30 to $1,000 in fewer than 3 years. And so between Tesla and Bitcoin, we had a very young following. And I think what saved the business was our willingness to pivot. You hear that word all the time. We spend too much time talking about active equity ETFs, and we should have been talking about disruptive innovation and open source research. We typically are going to be a small slice in terms of an equity allocation. And we have shown if you put 5 to 10% of our strategy, if you combine them with your plain vanilla growth indexes and value indexes, we do a couple of things. One, we provide a hedge against the disruption and disintermediation that will hit traditional benchmarks over time. And 2, we increase returns and lower risk over a 5-year holding period because the correlation of our returns with other strategies is very low. Most of the names in our portfolios are not in the broad-based indices. The overlap is anywhere from 2 to 5%. And that's because Tesla now is 2.2% of the S&P 500. So very little overlap. So the correlations of our returns relative to other strategies low. And from a diversification point of view, we're beginning to see more institutional interest because it's a good time to move into a category that has been pummeled where the correlations are low. The person who should be managing risk is the asset allocator. We are not an asset allocator. However, we do behave a lot like a value manager. We are not momentum driven, despite what it may look like. We are not. We are taking profits all the time. Tesla was up 50% last year. We took profits all year to allocate towards the names that were getting crushed by fears of interest rates and inflation going up. So we do manage risk in that way. We're not momentum driven. I've seen a lot of people get into trouble as momentum players, but we are not going to be able to avoid, the pummeling of innovation in the public